Okay, thank you so much for standing by as we switch gears to talk about budgets again, but we're going to focus today, or this part of the lecture, on what we call variances. A variance is a difference between the budgeted performance and the actual performance. Okay, I budgeted for this amount in sales, I actually got this amount. I budgeted for this amount of direct materials, I actually got this amount. That difference is called a variance. And so we're going to focus a lot on variances today. So let's jump into it. We learned about the master budgeting process. As you know, a master budget is based off of the expected levels of production. It starts with sales. The master budget starts with sales, number of units I expect to sell for each month. Okay. Based off of that, number of units times the sales amount, the sales price gets me the sales dollars. That drives the production budget, number of units I need to produce for each month. And that amount drives the direct materials, direct labor, factory overhead budgets. And that all drives for the cash budget. Yep. That's the master budgeting process. There are really two types of budgets that a company can go with. One's called a fixed budget, and the other is called flexible. Fixed budgets are also known as static budgets. These are budgets that do not change regardless of the level of activity. Okay. A perfect example of a type of company or agency that would use a fixed budget is the government. The federal government, the state government, the local government, they use fixed budgets. You give them a certain amount, that's it. There's no, you tell them exactly what is going to be spent on what, and that's it. You can't change it. All right, it's not going to go up or down, it stays the same. Yeah, that's a fixed budget, example of a fixed budget. Other companies that might use a fixed budget would include like nonprofit agencies, nonprofit businesses, something along those lines. Yeah. Most companies use what's called a flexible budget. Gives you some flexibility. Flexibility is based off of the level of activity. Okay, it's like, oh, my sales are 10% higher than what I thought they were going to be. That means I can adjust my budget by 10%. Okay, think of it like a tiered business, like I guess we call it tiered, or we could call it low, medium, high. Oh, on this end, the low end, I expect to sell 10,000 units. The medium side, or the expected 20,000 units. And on the high end, I expect to sell 30,000 units. We call it a flexible budget. And we adjust based off of those expected levels of activity. Yep. So here we have an example of a fixed budget. Again, a fixed budget means that it does not change regardless of the level of activity. With budgeting, as I mentioned, it's so important to compare the budget to the actual performance. You need to know where you're at. It's a part of benchmarking, like we talked about in the last chapter. Okay, we compare the budgeted to the actual performance. The difference is called a variance. The difference is called a variance. That's what variance means. Here we have an example of a fixed budget. Company planned to sell 100 units. They sold 140. You might think that that's a good thing. In some cases it is. In most cases it is. However, it's not so good for the cost. Okay. You sell more, that means there's more cost. Yeah. So budgeted sales dollars budgeted for 80,000. I came in at 105. That's a good thing. You made more. So that's you'll know the difference. 5,000. See the letter F next to that? That means favorable. Favorable. Favorable is a good thing. We favor that. We like that. Favorable. That's a good thing. You made more sales than you expected. Awesome. More sales dollars than you planned. That's a good thing. Okay. Now look at the variable cost. I expected a variable cost of 36,000. I actually came in at 54,600. Makes sense because you sold more. But more cost is not good. Okay? So that is a $18,600 unfavorable variance. The reason why it's unfavorable is because higher cost. Yeah, not good. Higher cost. So actual minus the budget gives you the variance. Then we have contribution margin. As you know, contribution margin is sales minus variable cost. Contribution margin budgeted was 44,000. I came in at 50,400. That's a good thing. Higher contribution margin as a result of higher sales. Contribution margin 6,400 variance. Difference between actual and fixed. Favorable. Good thing. Fixed cost. 20,000 was budgeted. 20,400 was the actual. I don't know where that $400 came from. No idea. That could have been a result of an increase in salaries. It could have been a result of an increase in depreciation expense. I don't know. But what I do know is that it's unfavorable. You planned on 20,000 fixed cost, you came in at 20,400. $400 unfavorable variance. Then we come down to income. We planned on having that income 24,000. We came in at 30,000. That's good. So $6,000 favorable variance for income. But you see what we're doing here, right? We're comparing the actual performance to the budgeted performance. And then when we do that, we create what's called variances. And those variances are the difference between the two. Favorable when we're talking about income being higher than the budget. Unfavorable is when your expenses are higher than the budget. Yeah. So you see the pattern. And notice that it's all positive numbers when you do variances. You're taking the higher of the two, finding the difference. Why do we have flexible budgets? Because they allow some maneuvering. Okay? They give me ranges of activity. Good thing, right? It gives you the what if. Well, what if I sell more? What if I sell less? What if I sell exactly what I planned? Yeah. It gives you ranges. It gives you that ability to adjust. And it also helps for future planning. So those are the reasons for flexible budgets and why they exist. Good things. So here we have an example of a flexible budget. I like to call this low, medium, high. The low end, I plan to sell 10,000 units. On the mid-range, I plan to sell 12,000 units. On the high end, I plan to sell 14,000 units. Okay? Okay, cool. So I got my units. Multiply that by my sales amount per unit. Find the total sales for each low, medium, high category. Do the same application for variable costs, low, medium, high. And I do the same process for fixed costs. But as you know, Fixed costs don't change. It doesn't matter how many units you produce. The fixed costs do not change. You can make 0 units, you still have to pay insurance, salaries, and depreciation on the machines. Fixed costs do not change regardless of the level of output. You remember that from the earliest conversations we had in this class back in week 1. So we have our low, medium, and high. That's a fixed budget. Flexible budget. Flexible budgets are great. Love flexible budgets. The total budgeted cost, we take the total fixed cost plus total variable cost per unit times the level of activity. Gives us total budgeted cost. Okay. Based off of our flexible budget, I can compare the budget to the actual performance. All right, great. So here's what we got. Flexible budget, 12,000 units. Okay, awesome. So we expected to sell 12,000 units. Sales would have been 120. And I have my variable and fixed costs associated with that. Here's the actual results. I sold 12,000. Oh, interesting. It came in at $125,000. Well, why is that? Because the average sales price went up greater than the $10 per unit. Okay. Oh, I increased my sales price. So I got a little bit more sales. You would think that that's a good thing. And it is, for the most part. Except for the costs. Okay. But we got $1,000 variance in sales. Direct materials went up. Okay. What happened? You might be asking. The cost of whatever, wood in this example, went up. It went up. Okay, well, there we go. So the cost of direct materials increased. Direct labor, $2,000 unfavorable. What happened? Hired an additional employee. Oh, no. What am I talking about? We spent more time, more training. Whoops. Okay, so 2,000 unfavorable. Direct materials, I used a little less. Great. $300 favorable. Sales commissions, I paid my salespeople a little less for whatever reason. $100 favorable. Total variable costs, 1,800 unfavorable. Whoops. Contribution margin is good. 3,200 favorable. Because, yeah, the sales prices were higher. Insurance went up. Paid an extra 200 unfavorable. I take my sales minus total variable costs minus total fixed costs to get my income. In this case, $3,000 favorable variance. So overall, we did all right. But you see the importance of comparing the actual to the budgeted amount. Yeah. Okay, so now that you have a basic understanding of variances and how they work, I want to show you a more detailed look at understanding variances. The reason why that's important to do and to know is because you need to understand the difference between the budgeted cost and the cost that you paid for direct materials, direct labor, and factory overhead. Okay, really, really important that you understand the differences between the standard cost, also known as the budgeted amount cost, and the actual. Yeah, very, very important to understand the differences between those two. So the way I want you to think about standard costs are That's the budgeted amount. Okay, so how do we set standard costs or budgeted amounts? Well, for direct materials, it's the cost of the materials times the quantity. That makes sense. I normally purchase 100 pounds of wood. The cost is normally $10 per pound. Okay, that gives me my standard cost for direct materials. Direct labor. Conduct what's called time studies. It gives us an idea of the amount of time that each employee is spending working on a particular job. Okay? Making a baseball bat, for example, or a hockey stick. They spend 15 minutes on average to make one hockey stick. Okay? Great. Times the average normal hourly rate, $12 per hour. We're looking at our earlier example from the last chapter. And then variable overhead, my resources. So let me show you an example. Let's say we make baseball bats instead of hockey sticks. Same concept. Here we go. Normal, standard. 2.2 pounds for each baseball bat made. The cost I pay per pound is normally $10. The standard cost is $10. So I'm budgeted for. So that's $22 per unit of direct materials cost I budget for. For direct labor, it takes 2 hours to make one baseball bat. Average employee makes $15 per hour. That's $30 of direct labor per baseball bat. For the overhead applied rate that the company determined is the amount of labor hours per unit, in this case 2, times $5 direct labor hour rate. It's applied. So 5 times 2, 10. Add up materials, direct labor, factory overhead, $62 per baseball bat, per unit. Okay, that's my standard cost per unit. Now, as a manager, you need to understand the difference between the standard cost, the average, the budgeted amount, the actual. We look at the difference to find the variance. We do that for direct materials, direct labor, and factory overhead. We call these cost variances. It's the difference between actual and standard. If the actual cost is less than the standard cost, it's favorable. Just like with budgeting. If the actual cost is less than the budgeted cost, it's a good thing. Yeah, it's favorable. However, if the actual cost is greater than the standard cost, it's unfavorable. Not so good. You spent more than you should have. So, in order for us to understand how to prepare a cost variance analysis, we go through these 4 steps. Number 1 is to prepare the standard cost performance, okay? Number 2 is we analyze the variance, compute and analyze the variance, actual minus the standard cost, to find the variance. Number 3, we identify any questions, and number 4, take corrective action. That's the process. So let's move through it. This is the standard formula that we use to find the cost variance. It's the actual cost minus the standard cost. Sounds straightforward. You'll notice that there's a few components for each of those, right? For actual cost, it's simple. Actual quantity times the actual price. That gives you the actual cost. That makes sense. Minus the standard cost. The standard quantity times the standard price gives you the standard cost. Makes sense. So actual cost minus standard cost gives you the cost variance. This is the formula we use. Very simple form. It gets a little more complex, and I'm going to show you what that looks like. So first, we need to figure out our direct materials and direct labor variances. You know the formula. It's actual minus the standard. Okay, so we need to break it down to find the cost variance. There are two variances you need to compute. First is called the price variance. As its name implies, the difference in price. And the quantity variance. Again, as the name implies, difference in quantity. You'll notice the formula. It's broken out a little bit differently. Okay? To find the price variance, we take the actual price minus the standard price. Then we multiply that by the actual quantity. Because, we got to find the actual variance for the standard price. Right? So, actual price minus standard price, we multiply that by the actual quantity once we actually purchased. That gives us the price variance. What about the quantity variance? We take the actual quantity minus the standard quantity and multiply that by the standard price. Okay? That gives us the quantity variance. Okay, those two formulas are very complex. I want you to do your best to try to remember them, write them down, whatever. They're very, very difficult formulas to remember. At least they are for me, anyway. I don't know what they are for you, but they're very difficult to remember, I promise you. So it's just take note, because this part is probably the most difficult part of the chapter, in my opinion. And actually, of most of accounting, I find this to be the most difficult. I've always struggled computing variances. And a lot of it's just because I can never remember the formula. Yeah, it's difficult to remember. Okay, so for direct materials and direct labor, these are the variances we need to know. So price variance and quantity variance. Together they equal the cost variance. Yeah. Important to remember. Okay, now let's put it into an example so that way we'll make it easier to understand. So here we have direct materials variance for the company selling our baseball bats, I guess. All right, here's what we got. We produced and sold 3,500 baseball bats. In that, we used 1,800 pounds of wood at a purchase price of $21 a pound. The standard amount of wood that we normally use is 1,750, which is half a pound of wood per baseball bat at $20 a pound. So we have a lot of information here. We have the actual and the standard. We actually purchased 1,800 pounds at $21 per pound of wood. giving us an actual cost of $37,800. The standard budgeted amount, 1,750 pounds, 1,750 pounds, at $20 per pound. Standard cost of 35,000. Actual minus the standard gives us an unfavorable variance of 2,800. Take a look below there. Remember that crazy formula. Yeah. The price variance, the quantity variance. Let's take a look at how we computed these. Okay. We take the actual cost, actual quantity times the actual price, getting us to 37,800. Then we did the standard cost, standard quantity, standard price, getting us to 35,000. Okay. In the middle here, we have our cost variance. The cost variance is actual quantity times the standard price. That gives us 36,000. To find the price variance, we take the actual cost minus the cost variance found in the middle. Yeah. Find the price variance. So the actual minus the actual times the standard. Yeah. Gets us a price variance of 1,800. Unfavorable, of course. And we got the quantity variance. How we found quantity variance. We got our standard cost, the actual quantity times the standard price minus the standard cost gives us $1,000 unfavorable quantity variance. We add those two together to get a total direct materials variance 2,800 unfavorable. It's just a way of breaking it down visually to understand the variances. We apply the same principle to direct labor. So when we look at this type of variance, we got to figure out what went wrong. All right, as a manager, did we pay too much? Was the cost inflated? Who's responsible for this? Is it the purchasing manager? Is it the negotiator? I don't know. But as a manager, we got to get to the bottom of the variance. It's like, well, we can't have an unfavorable variance. Yeah, it's not good. That we purchased too much materials? Was the quality of the materials too poor? What caused it? What caused the variance? Important to evaluate the variance. Let's look at direct labor real quick. As I mentioned, it's the same process, same type of formula applied to labor. Okay, here we have the same information. We produced and sold 3,500 baseball bats. We used 1,700 labor hours at $33 per hour. Okay, that's the actual. Then the standard. We normally only use 1,750 pounds of wood, half a pound of wood per unit. I'm sorry. It takes a half an hour per unit to produce one baseball bat at $32 per hour. So here we have actual 1,700 hours times $33 per hour, 56,100. The standard 1,750 hours at $32 per hour, giving us 56,000. Actual minus standard gives us an unfavorable variance of $100. Okay, great. How did we get there? How do we get there? So we go through that same process. The actual hours times the actual rate gives us the actual cost, 56,100. Then we do the standard standard hours times the standard rate gives us 56,000. What about the total cost variance? We take the actual hours times the standard rate. Get 54,400. Actual minus cost variance, getting us unfavorable rate variance, 1,700. The efficiency variance, meaning how efficient our employees are at making a baseball bat, we took the cost variance minus the standard cost, $1,600 favorable efficiency variance. How do we get to 100? The rate variance minus the efficiency variance gets us $100 of unfavorable direct labor variance. Yeah. Again, it's relatively complex. This topic's relatively complex, so it's important that you walk slowly through the process. Okay, I'm cautioning all of you. This is probably like one of the most difficult parts of this course, in my opinion. Our understanding and calculating variances. So please take your time with it, follow the process, follow the formula. As long as you do those things, you'll be all right. So why did labor variances happen? It depends on the employee's skills, training, cost of training, those types of things. Those cause labor variances. Okay, and then of course overhead variances are something we need to understand as well. As we talked about in budgeting, one of the things that we look at are the budgets for our overhead. And this gives us an example here based off of flexible budgeting, how that type of overhead would be computed. So here we use our capacity. Capacity is the amount of production that is available, right, at that facility. There's 70%, 80%, 90%, and 100% production. Capacity. Number of units, the most number of units I can produce is 5,000 units in this example. The most I could ever produce. Okay. 80% is 4,500, 80% 4,000, 3,500 is 70%, etc. I run out based off of those percentages to find the variable cost at each level of capacity. And of course, we have our fixed costs that do not change regardless of the capacity. So based off of that information, I can look at computing my standard overhead rate. So this is how companies typically do it. They take the budgeted overhead at predicted level of activity, like 80%, 90%, whatever, 100%. Divided by the standard allocation base at that predicted activity level. We'll do this in 3 steps. 1 is we determine the base. 2 is we identify the predicted level. And 3, we compute the overhead rate using this formula. So I can apply this formula. So here we have an example. I think this was at 70% if I'm not mistaken. We have the 20,000 of budgeted overhead divided by 2,000 direct labor hours, which is the base, giving us $10 per direct labor hour of standard applied overhead. Okay. Then I find my actual. Yeah, my actual comes in, actual total overhead minus the standard, gives me the variance. So actual minus standard gives you variance. This one's pretty straightforward. Overhead's pretty straightforward in this case. There's a couple of other variances to be aware of that I'm going to quickly go through. One of them is called the volume variance. Again, it's pretty straightforward. In this case, we take the actual minus the standard to get the overhead variance, just as we do with any other variance. The same formula applies to all variances, yeah? Actual minus standard. Controllable variances, same process applies. Actual minus standard. Usually at the end of a manufacturing period, we produce what's called an overhead variance report that gives you the variances for each budgeted item. This can be summarized based off of the product cost variance, which gives you the direct materials variance, direct labor variance, and factory overhead variance. This slide just kind of summarizes all the variances we just discussed throughout the past few minutes. Of course, throughout the budgeting process and variance process, we also need to look at things like sales variances. Well, you said you were going to sell this amount, you actually sold this amount, okay? We do that for both sales dollars, sales price, and for units. And the sales variance, of course, is computed the same exact way. Actual minus the standard, the budget amount. You can compute overhead variances, of course, for a couple of different things, including spending. So this gives us kind of a flow chart of that process. Very straightforward. But just remember, actual minus standard. That's the very basics in essence. And here we have a summary of those formulas again. This is for overhead variances for both fixed and variable cost. Again, same process. And we do the same thing for variable and overhead costs. And then lastly, a couple of journal entries that we need to make when we do have variances. Because especially with direct materials, direct labor, factory overhead variances, we need to make those adjusting entries for those variances. And these are examples of those. So this one's for direct materials. You see that we have our work in process. Then we would debit materials variance and for price and quantity. Of course, if for labor, we make those adjustments as well. And for overhead. Okay. Are there any questions that you have about variances or flexible budgets? Any questions I can answer about those? No? We're good? Straightforward? I know it. Take your time with those formulas. Please take your time. As I had mentioned, for me, variances is probably the most difficult concept in accounting to understand. It really is. Because you get with too much data, you can really get lost in it. So just take your time. Okay? Just remember the formulas. Take your notes on those formulas because I'm telling you, it can get really, really confusing. But that's my recommendation. Just take your time with it. Okay, quick reminder, and then I'll let you all go. So in the classroom, where are we? We're in week 5. Yeah, I know it goes by so quick, doesn't it? So what do you have to do by Sunday? Well, by Thursday, I really need you to do that week 10 discussion, your original post. That gives you some time to respond to your classmates, yeah? So what's going on in that discussion, just to kind of give you an idea, I want you to choose any of these topics. There's 6 topics, okay? Just choose one. And I want you to work through it, okay? With an example or with whatever, yeah? Just illustrate it for us. Show us some concepts that you're learning. So you'll answer basically the sub-questions when you select one of these, yeah? And then I want you to respond to at least one of your classmates, yeah? That's the discussion. Then you also have the hypothesis, which I made sure is working. And yes, it's still working, so that's a good thing. So just like before with the hypothesis, you're doing some highlighting and commentary. And then you have chapter 22 quiz and chapter 23 quiz. So those 4 things definitely need to be done by Sunday night, okay? It's important that we get up to speed because there's only 2 weeks left of class. The end of the semester is approaching. The last day of class is December 3rd. That's the last day of the semester, okay? Today's November 14th. So it goes by really fast. So please, 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 if you're missing any work, late with any work, whatever, I need you to get it done. Because remember, the only way you can pass this course is to do all the work. That's it, It's a lot of work, yeah. I need you to do it. That's how you're going to pass. Comments, questions, concerns? Well,
Oh no, just something personal after class.
okay, I got you. I got you.
Thank you.
I'll hold off for you. Okay, any other comments, questions, concerns about anything we talked about today or anything at all? Okay. If you need any help, you have any questions, you can always email me, call me, set up office hours. All those things, you know how to get me. I'm always here for you. So again, apologize about the last 2 weeks, but life happens to us all. So we're back. We're up and running. So again, you need anything, I'm here for you. Thank you all so much for your time today. Appreciate all of you. Enjoy the rest of your day. Thank you so much. Take care. Bye-bye.
Have a nice
Good night.
night.
Appreciate you. Take care. Bye-bye.